Hello, everyone. My name is Rufus Kamau, Markets Analyst at FX Pesa, and I'm going to be taking you through today's webinar. So as we all know, this is a VIP webinar. We do this once a month, trying to focus on some of our most traded assets, key topics influencing the markets as well as price action. So we try to vary the topic now and then or every month. And in this particular webinar, we will be focusing on ways of looking for quality trades in gold, oil, as well as major currency pairs. So be prepared for a very technical lesson, majorly focusing on price action. So I do not have a special set of indicators that I'll be recommending today. Today, we'll be looking at pure price action, trying to understand how these assets move, and how you can take advantage of these movements just by analyzing the charts, looking at the highs, the lows, support, resistance, trend lines, and all that. So as we progress, make this as interactive as possible. So if you have any questions arising from the presentation, then feel free to type those questions in the Q&A section or in the live chat section, and I'll be responding right away. So first things first, I would like to mention that this is not a beginner session. So if you consider yourself a beginner, it might not be very appropriate for you. So in case you're a beginner, there's a session that we have done on YouTube. It's called the Novice to Pro series. It's available on the FX Pesa channel. So I'm going to share the link of the Novice to Pro series. It has 10 episodes. So if you would like to go through a refresher course in terms of running the basics of price action, opening and customizing your charts and all that, then you will get that from the link. Go through the 10 episodes, and once you are through, hopefully you'll be in a much better position trading wise. So let me share this on the live chat section. So there's a link to the first video of the Novice to Pro series. So before we proceed, I would like to do a mic test. So if you can hear me clearly, kindly type hi on the live comment section, and these will confirm to me that everything is working just fine. So Patrick raised the hand. I'm not sure if you can hear me. I don't know if you can be able to respond on the comment section. Hi, Tashi. Is my voice clear? Hello?
You first.
Hi, Tashi. I'm just calling to make sure that my voice is clear.
Yes, it is.
Awesome. So let's proceed. So first things first, I would like us to begin with a very important concept. And this concept is very common in these assets, mainly because they are very volatile. And the concept I want us to learn today is called liquidity grab. So I'll try and share these. So the liquidity grab is quite a common feature that happens in the markets. So let's say you have a chart. Let's say these are a chart. Majority, let's say you're trading gold or Euro USD or whatever asset you prefer. And then as you trade, you realize something like this happening. So I'm going to do a rough chart. So market is going up and then down and then up and then down and then up and then down. And then let's say at this moment, you do your analysis. Let's say you are a technical trader. And then being a technical trader, you realize that there's a nice support that is forming on your chart, and you'd like to capitalize on that. So you take your very first point here, and then you connect this to the second point, and let's say you have a trend line here. So as a trader, most commonly, you will go for a bullish position. So after you go for your bullish position, we have seen a lot of price action traders do this. You go for a buy trade here. So I'll try and label these. So after you go for your buy position here, then as you observe the price action, you notice something different happening. So at first, the market goes up as if it's bouncing from that level. Then after some time, it drops all the way down, hits a stop loss, and then immediately goes back up as projected. So it's quite a common scenario in the markets. You might notice this happening every now and then, and we describe this particular scenario as a liquidity grab. So this can sometimes happen. The market triggers a stop loss, and then eventually the trade goes as projected. So whereas a lot of beginner traders might find this as a very bad scenario in the market, and they may even avoid trading support and resistance levels, because every time you're looking for a good entry on this area, market triggers your stop loss and then moves in the original direction as projected. Then instead of seeing this as a bad thing, I think it's a better idea to look at these as a unique opportunity to grab a strong entry position whenever there is a liquidity grab. So this happens quite frequently in the markets. So let's see if you can identify potential where this happened. So let's start with a simple chart such as a Euro USD. So in this case, you can see the Euro USD was largely bearish going down, and then it moves up and then back down. So if you are to be analyzing this asset, assuming you just have one point here, so your point is this particular bottom here. So the next point is where the market bounces next. So after the market goes up and then goes back down to the same level, then it moves back up. Then you are extending your trend line, hoping that the market will do the same thing once it gets to the trend line. So let's analyze this particular scenario here. So the market drops again towards your trend line. So just to give some clarity, you have the lowest point here connecting into a trend line, and then you extend this to the future. So as the market moves back to the same trend line, so notice what happens. The market attempts to break this area. There's a very nice green candlestick that we can basically describe as a bullish engulfing. So in this bullish engulfing, it basically triggers traders signaling that it's time to enter and go for a buy trade. So what happens then is that the market forms a pin bar here, and then on the next candlestick, it goes all the way up and then pulls back immediately. So next candlestick is green and then drops all the way down, and then even further down, grabbing the stop losses of the traders who had gone for a buy position here. So technically, you'll find that after this is formed, a trader will go for a buy trade here. They'll probably set a stop loss below this candlestick or a couple of pips lower, let's say here. And then they'll set their target on the upper trend line, maybe based on the recent price action. So in this case, the most recent price action would be, let's say, this high, and then these, and then these, and then these. So if you are to do, let's say, some line of best fit, it would probably be along these areas here, connecting this high along with these. They are close enough, but not at the trend line, and then here. So let's say use the same principle and use the tough edges here, the highest price level here, and let's say even the price highest price level here. So this doesn't make sense. It's an extension. So we try to use this area here where we can see a lot of candlesticks rejecting this area. So as you draw your trend line and project a target here, then as a trader, you're expecting that after these, the market heads straight to the trend line. And on the other hand, if you are wrong, then the market goes back down to trigger your stop loss. So your idea is to go for a buy trade here, set a stop loss here, and then a take profit here. So what happens is that the market goes up for a moment and then drops all the way, kicks you out of the market by triggering your stop loss, and then immediately goes all the way up as you had projected. So the idea today is to avoid this early entry and then wait for the actual liquidity grab. So in this case, instead of trading all these, I would remove this, and then this was the entry. So I remove it, stop loss, I remove it. And now we look at this transaction closely. So what we are seeing here is a market that goes straight down. So as a trader, let's say you have your trend lines and you're just following the market looking for an entry position. So when this happens, you should be aware that there's a good chance that the market will go for this other particular pattern here, where it triggers stops in what we are calling the liquidity grab today. And after grabbing, that liquidity moves in the opposite direction. So in this case, after seeing these, it should get you very excited, but not trigger an entry for a buy position. So you remain patient, waiting to see if this will happen. So market drops, then drops again, and then makes an immediate comeback here with a very strong green candlestick. So this now indicates that the market has already triggered stops. Buyers have entered strongly in this market, and it's time to go for the original idea that these traders had here. So in this case, immediately after the reversal here, this is when you go for your buy trade, target this area, and you set your stop loss just below the pattern. So you are still trading the same pattern you could have traded on the RS signal, but now with more confidence after these guys have been stopped out of the market. So in this case, you go for your buy position here, target this area and your stop loss here. And that way you can have a much more success rate compared to guys who are trading this area entry. So it's quite common in the markets to identify these price action patterns. And whenever they happen, you can always grab that opportunity and make some good run. So that's quite a good way for trading these assets such as gold, oil, as well as the major currency pairs. So if you look at these, you will notice that it's quite common. So let's look at another one. And this is not the past. This is just a couple of days ago. So market forms a bottom here, then another bottom here, and then look at this. Look at this. So gets all the way down here. So these are our lowest price. We have this area here where there's a lot of support before the market changes direction. And now you can see here the market dropping all the way and bouncing here. So sometimes it's not always like I described in the previous example. So sometimes you will see these, sometimes you will see these acting as a major support and the market bouncing from there. Then in this case, you have this immediate thing happening. So it's not always a case that when the market is bouncing, that it will always grab that liquidity. But whenever it happens, then you can get to benefit from that. So notice the same thing. Let's say we have an upper trend line here, marking this resistance here. So in this case, you've been marking this area here, this area, and also this area. So now, if you look at this other side, and we adjust our trend line very well to capture this end here and also this tail, then you can see where the liquidity grab happened. So the liquidity grab happened in this area where the market basically forms a reversal pattern, and immediately the sellers in this market go for a short selling position targeting the previous low all the way down here, and then they just set their stop loss here, just above this pattern here. So what happens in this case, the market heads straight up, breaks this area and shoots all the way up, but on the very next candlestick goes right back into the pattern, indicating your liquidity grab entry point. So in this case, after the formation of this pattern, now it's much safer to go for the same idea, but after the liquidity grab has happened. So in this case, stop loss goes there, and then the original target remains the same. So in this case, you go for a short selling trade targeting even lower prices. So for anyone who have been trading gold, you can see now it's quite clear that this was a good entry, and now we're expecting the momentum to continue all the way down. So it's quite a common thing to happen in the markets, happens on both horizontal markets as well as trending markets. So trending markets are basically markets that are consistently forming lower lows and lower highs, as well as a bullish market where you have consistently higher highs as well as higher lows. So you will be seeing these patterns happening frequently, but these happens only if you're very patient and you are conscious about the pattern and you are actively looking for that pattern. So let's see if we can get a couple of more examples of the same before we move to our next pattern to be watching out for. So here we have another one. I would say this is a pretty good trend line. So try to zoom out. Sorry. So I want to extend my trend line all the way back. So if you're analyzing this pair, you're probably following this. You're probably following this low and then trying to connect this low with the next, trying to understand where the support levels lie. So you have your first point, you have your second point, third, fourth, and you keep on adjusting your trend line like this. So in this case, you would be having a trend line such as this one. The market drops sharply, indicating a very strong break here. And whenever you see such price action here, it's most often as a result of news happening in the markets. So in this case, there was some news happening some time back and the market broke all the way down. So immediately after the effect of the news came to an end, you can see what followed later. So the market began picking pace towards the upper direction, eventually getting back into pattern. And these convinced out of traders that this move is reversing, and now you're getting back to pattern. So what happens is a lot of traders get caught up in this buy, expecting the entire move to reverse, and then they set their stop loss just below the pattern here, targeting all the way up. So let's say they have some short-term targets aligned along this area. Let's say based on this high, and now they're projecting that once they go for this trade, they are expecting the price to move all the way up. So what indeed happens is that the market makes a very sharp and quick drop, grabs the stop losses that were around this area, and immediately after that, the market rallies all the way as projected. So the trigger for you would be identifying this area where a lot of traders are setting their stop losses, the market going to that area and grabbing that liquidity, and then making an immediate reversal here. So after this happens, you go for your buy trade here, target this area, and the stop loss goes just below. So it's something that you will find in the markets consistently. And once you understand how it plays out, then in most cases, you will be very profitable. So let's look at one more example. This is a very key support level for Audi USD currency pair. This is the 30 minutes chart. So 3 days ago, the market was sharply dropping downwards, go to this area, and then rallied, continued rallying for a second day, then pulled back down for a third. And then on the fourth day, we got into this key level support. So from this area, you can see that the market bounces immediately, and this triggers an entry, telling the buyers that the market is now headed higher. So the trigger here is the 2 candlesticks here with long lower tails indicating a rejection of lower prices, and now suggesting that the market is headed up. So for all those traders that are squeezed in some position here, even the sharp green candlestick here indicates a strength and the market is headed even higher. So what happens after that is that the market drops sharply, gets to this previous low, triggers a lot of stop losses, and then immediately after triggering these stop losses, you can see now it's beginning to pump higher. So the idea is to avoid this and go for this. So the second one is usually a much stronger signal compared to the first one. So in this case, sometimes it's important to use daily targets. So for instance, today's high can be used as a daily target for USD, expecting the rally. to go all the way up and get to this previous high. So in this case, the stop loss would simply be this area. So remember, this is not investment advice, nor is it a recommendation to trade. So this is purely educational to help you understand these key concepts. And then you can easily use these concepts in your trading. So you will be finding these patterns are happening more often than not. And once you understand what to look for, then you'll know how to position yourself in such cases. So for instance, let's look at this. We have this high connected with this high, and then this high, and then the previous high. And now what we are seeing is the market heading straight for that particular resistance line. So remember, there's a very common mistake and a very common saying, which I consider a mistake, that the more a resistance level has been tested, the stronger it is, or the more a support level has been tested, the stronger it is. In fact, the reverse is true. So the more a level gets tested in the financial markets, the weaker it becomes, and the higher the likelihood that that level will be broken. So in this case, we're looking at the 4-hour chart of the USD Swiss franc currency pair. The market is headed right for this particular area here. So the expectation here for a technical trader, if the market remains within pattern, you expect that the market will hit this area and then drop back downwards. So if this happens for the first time and you go for an early trade, you might find yourself getting trapped and the market hitting your stop loss and then the same thing happening. However, if you are a little bit patient and you wait for the actual liquidity grab, then you might capture an even better position. So I see someone is raising a hand. I don't know if there's an issue either with my voice or the presentation. So if there is an issue, kindly type on the comment section and I'll be responding right away. So just for a test, anyone reasoning, kindly type something on the comment or the questions section so that I can confirm that this is working. I remember we had a previous problem in the last webinar. All right, let's keep on progressing. Awesome, we have a good response. Thank you, Owen. I appreciate this. So the same thing is happening in pound USD, and now it will be very clear for you since we have already gone through the same. So let's look at how this one happened here. So the pound USD was basically trading sideways for quite a period of time. You can see this particular resistance here holding very well, and also a support level holding very well. So remember, this was the price action of Monday when the US market was closed. So the market was majorly moving sideways. A slight break here gets back into pattern, and then eventually it forms a breakout. So for majority of the content that you'll find online teaching you about a breakout, it will tell you that once a candlestick closes below the support, you go for a short selling trade, and if you're not sure, then you wait for a confirmation. So when the confirmation happens here for the red candlestick here, what actually happens is that it triggers a lot of traders to go for a short selling trade, and the market reverses immediately. So once the market reverses immediately, then you realize that, oh, the breakout is not on this side, it's probably going to be on the other side, and immediately you reverse and go for a buy trade. So there is a lot of traders that now, using the green candlestick, decide to go long, knowing that this was a false break, and now they're expecting the market to break towards the other side. So when they set their stop losses along this area, just below the support, guess what happens? The market heads straight, grabs all that liquidity, all those stop losses that were set around that area, and then jumps all the way up and breaks even the upper trend line. So in this case, the liquidity grab was on the first one. This was the first breakout, and then eventually the market makes a move upwards. So you have to identify these patterns and how they play out. And once you identify the area that the market is capturing this liquidity, then you trade with the smart money on the opposite direction. So let's keep going. That's one of the key trading ideas I feel like are very much potent. So we have already seen it happening in the current price action in gold here. We have seen it happening in the current price action in AUD/USD, and hopefully we'll get to see it in even more assets as we progress. So now that you have gone through that, let's take Euro/USD, and then we do a technical analysis of this chart. So as you all know, it's very important to understand what's happening on a larger price action level. So for Euro/USD, on the daily chart, we know that the euro was majorly losing against the dollar, and this was the trend line that the market was following, and this lasted for the entire year last year. So the dollar consistently, the dollar consistently gaining against the euro. So at some point we saw the Euro/USD trading below parity, or a level where 1 euro was cheaper than the dollar. So after this, we saw the market changing direction, breaking out, and then rallying all the way up before we got to this resistance, and now it seems to be pulling back down. So from the forward chart, now if we zoom out, we can see how the market has been pushing higher. So clearly, we can see that the upper trend line is something we can identify with. So this seems like a common theme in this market. So this was the highest price reached, way below the trend line. So the trend line seems to be touching these areas here. So we have this high along this high, and the market was consistently pushing along that direction. So on the lower side, we can say, if we use this area here as a anchor for this one, the Euro/USD was basically following this pattern, and if we zoom, we can see the sequence where the market is basically moving from one trend line to the other, keeps on pushing along that line, get back to the lower trend line, and then all the way up, and then back to the lower trend line. So what we are seeing here is a period of time when the Euro/USD was making a very strong recovery between September last year and January this year. So after we got to this high, the market dropped and broke the lower trend line. And now what we are seeing is the market trading in what looks like a triangle. So triangles are quite a common scenario in price action trading, since they represent a period of time where the market is virtually moving sideways, but then you see the swings getting smaller and smaller. So in this case, you can see that the first swing was quite significant here. Second swing was significant, third, and now as we get towards this end of the trend lines, the price action is getting slower and slower, which basically implies that potentially we will be seeing a breakout happening on Euro/USD. And remember, this is happening on the forward charts. So now, if we narrow down to an even smaller time frame, and this is the 1 hour chart, we can always identify patterns within patterns. And whenever this happens, then it can be a very interesting area to look for trading positions. So for instance, if we were to get more accurate with this trend line and actually connect it with the second point. So remember, the trend line begins on the left-hand side. So you mark your first point and then your second point, then you are able to wait for your third point. So you can already see the same pattern happening here. So the pattern happened here, market got to the support, bounced very well, went back down and then up. And now look at this, market goes back down to support, bounces very well, goes back down, grabs that liquidity. So for anyone who went for a buy trade as a result of this, market went down, stops you out. So even if you had moved your stop to break even, you still get stopped out. And then the market seems to be bouncing, and there is a good chance that we will be seeing that the market now going for a rally and getting all the way up towards the upper trend line. So it's quite a common scenario. You just have to be very observant, do your analysis, and identify such potential opportunities. So a disclaimer, this particular pattern will not always be profitable. So there are some times when you will be going for these positions, and then the market goes ahead and stops you out again. So this doesn't mean that the strategy is bad. It only means that you are trading probabilities, and by trading probabilities, you acknowledge that sometimes you will not always be right. So you have to practice money management at all times. So you have to do proper risk management. So it doesn't mean that now you have identified that these guys have been stopped out and now this is your idea of buy position here. It doesn't mean that now you take extra risk. So if you normally risk $50 a trade, doesn't mean that you go for $100. So if your normal risk appetite is $500 a trade, doesn't mean that you now go for $5,000. So you still remain within your risk parameters, knowing that you have a better setup. And if you trust that system, then there's a good chance that you'll be seeing this work for you. So I hope I was helpful tonight and I managed to provide quality insights on price action trading. So now I'll be opening the session for Q&A. So if you have any questions and comments around the same, kindly feel free to type in the chat or the Q&A section, and I'll be responding to these questions right away. So this marks the end of my presentation tonight. So don't be afraid, just type the question and I'll be responding right away. Good one, good one. So we have a question from Owen. This is about my take on the FOMC tonight. So FOMC, short for Federal Open Market Committee, we know that it has been quite vibrant last year, and also this year we started very well. So in January, the Fed made yet the smallest rate hike. So remember last year, it made 4 consecutive 75 basis points hikes. And then towards the end of the year in December, it made a small one, which was 50 basis points. In January, there was no meeting. So the only meeting we have this year is on February. I think it was on 1st of February, where the Fed went for the smallest rate hike of 25 basis points, indicating that the economy was responding well and they were seeing inflation easing down. So by then, inflation was 6.5%. So in the most recent reading, inflation dropped slightly lower on the year to 6.4%. But then on the month, it was a big spike, indicating that inflationary pressure is coming back to the US. So in this case, there was discussions during the meeting, and eventually they agreed to hike by 25 basis points. So now what we're expecting tonight at 10 p.m. is the minutes of that February meeting. So on those meetings, we will be looking to see the discussions and see if there were members that were in favor of a 50 basis point hike. So if there were members who are in favor for a 50 basis point hike, and then consider the current data that we have, we had a record number of jobs in January. CPI came in hotter than expected. Manufacturing not responding as well. Same case is happening to retail sales. They are very strong. The US consumer is very strong. And this basically raises the inflationary pressure. So the Fed needs to react to this. So as the markets are adjusting to this new information, we have seen US dollar pairs continue to strengthen. The dollar index has been quite strong, and also equities have been very weak. So if there's more indications that there were more FOMC members who are in support for a stronger rate hike, then this would be very positive for the dollar and very negative for US equities. So in this case, we'll be looking to dig deeper into the report. So if you happen to have some time, kindly go through the report before reacting to the information. So On another note, if a lot of Fed members were against the rate hike, then in this case, we might be considering a much stronger dollar, sorry, a much weaker dollar and stronger equities. So let's see. There's an anonymous comment. So this explains why I'm always kicked out. Used to think the market was against me. Yes, it happens. So whenever you see these liquidity grabs happening, mostly is the bigger players in the market trying to find the other side of their trade. So technically, if a couple of banks had a very large buy position in pound USD, let's say they want to buy a very big order, they need someone to take the other side. And of course, they are able to find areas where a majority of the traders will set their orders, mostly stop losses. So they will be able to target that area and drive the market from there to fill their orders. So is there a tutorial that you have for absolute beginners? Yes, I shared this on the live chat section. So you simply scroll through the live chat and you will find the link. So don't know if I can copy the link and share the link again. So I have a 10 episode series called Novice to Pro. So kindly go through it and it will take you through all the beginner stuff. So another comment here about AUDUSD. A downtrend has been observed 2 consecutive days. What might be the reason? So the reason is clearly the dollar. The dollar has been very, very strong. So by the dollar being this strong, it's majorly as a result of the market adjusting to the reality that the Fed could continue hiking interest rates and keep them higher for longer. So if you look at the 1 hour chart and you look at these, you can see that the market was already beginning to make a recovery. So from, let's say, the trend lines, you can notice that this was clearly progressive, the market going up. So the swings were forming literally higher highs as well as higher lows. And now, after getting to this high, we are getting another sequence downwards, which is very similar to what is actually happening with gold. So if you look at the chart of AUDUSD and then compare it with gold, there is some very funny correlation happening. So you can observe now that the market is projecting to move this way. And the FOMC meeting minutes could have an influence on this. So the way the market performs after this could be influenced by the news. However, as per now, as long as we are not expecting any news to be moving the markets, the idea is that there was a liquidity grab here and the market could be headed back up towards the upper trend line. So yes, the dollar has been quite strong, but at the same time, we might be seeing the FOMC meeting minutes influence the movement of AUDUSD as well as other dollar pairs. So if you are looking to, let's say, make a market entry now, you have to be very aware that there could be increased volatility, especially at around 10 p.m. So if there was no news, then for me, it would be obvious to look for a very quick position targeting this area and my stop loss just below here. So also another comment, thanks. Today's session was so insightful. I think I understand why I lose trades. I hope you grabbed the concept and you'll find it easy to apply in your trading. And thank you for the comment. Where do you follow up this news from? Please share. So when it comes to news, market announcements, I normally use a website called Forex Factory. So I'll type the website here. And also for market updates, you might want to look into a very not so popular website called financialjuice.com. So I'll also share that. Whenever you have time, you can go through them and you'll get quick updates on what's happening in these markets. So thank you very much, guys. I appreciate your time and also your feedback, and I hope to see you on the next session. So we'll continue doing updates on the live channel So be very vigilant whenever you see these. So potentially, if we get similar updates of liquidity grabs, we could be sharing a chart every now and then to help keep you updated on the same.